All right, so the final question for today's episode comes in from Lisa. Lisa asked, I'm worried about the tax implications of investing. What should I know? Lisa, thanks for the question. Tax is unfortunately one of those tricky ones where it's a necessary evil in some regards, where no one necessarily wants to or likes paying tax. But once you understand, and obviously depending on which country you live in, once you understand why you pay tax and the benefits that you get from paying tax to an economy like Australia, is somewhat tolerable, if that's the way to put it. But when it comes to investing and tax, there's a couple of things that you do need to know, and there's two sides of it. So there's the income tax that you pay, and then there's a capital gains tax. So income tax, much like the income that you earn from if you have a job, you get paid from your job, you pay tax on that money. So if you earn money through investments, if we take the example of real estate, it gets a little bit complicated, but if we take the example where you get rental income, that rental income is income and you have to pay tax on it. Now, when it comes to real estate investing, which we'll cover a lot more in next week, but when it comes to real estate investing, you have the rental income. So if you're getting paid $1,000 a week from your rental property, then you have all the deductions and expenses that you can deduct from that income, much like you would in your personal income. When you lodge your tax return, you would say, this is the income I earned from my employee, but I had all these deductions that were work related. So this is my car, my phone, my home office, my work clothes, all that kind of stuff that you used, all those expenses you incurred to earn that income are deductible. So those are tax deductions. So the same thing happens with real estate. If you have an investment property, $1,000 income comes in, but then you have all those expenses that are related to you earning that income. So some of it might be the interest on your home loan, the property management fees, any like repairs and maintenance you had for the property, any bills, expenses, and things like that that come with that property. Those are deductions. So we have the gross income that you earn, which would be the $1,000 a week, less all the deductions, and then you'd have your net income. So that net income, which is income minus the deductible expenses, that net income gets added to your tax return at the end of the year. So let's say you get to the end of the year and you've earned $20,000 from your real estate investment. You have $100,000 in salary, you take that net income from the rental property and add that to your salary, and that would be your taxable income in $120,000. So that's the income side of it. It is quite complicated. And the issue that I find, or the thing that I find that people aren't aware of, is when they have what's called a positively geared investment property or a positive cash flow investment properties. And that is they're making money. So the income they're earning is more than the expenses related to that property. So therefore they're making money. So then they have to pay tax on it. And what happens when you don't have appropriate money set aside? So you might have gone 3, 4, 5 years of working and never had an investment property, never made money from an investment property, then your employer is always paying the appropriate amount of tax for you. So you might not have to pay any additional tax at the end of the year, or you might get a tax refund. Then you add an investment property, and if you're not careful, that if you're earning money and you're earning extra taxable income, which is a good thing, it's always important that you set aside an appropriate amount of money in case you have to pay additional tax. So it gets to that point where your employer is putting the money away for you from your earned income, your income from your work, but they don't know that you have an investment property on the side. They don't know you have these other investments. So they're not putting tax away for that. They're only putting tax away for the money they need to, which is your salary income. It's your responsibility to put away or set aside the appropriate amount of tax for any other additional taxable income that you might have to pay tax on. So that's the income tax side of it. And the same is applicable for stocks or shares investment portfolio that you might have. So what we just spoke about then was the real estate side of it. But when it comes to an investment portfolio, like we covered last week, where we have the rental income for a property, we have the dividend income from an investment portfolio. So any dividends that you earn from an investment, gross income, same thing as when it comes to real estate, the amount of money that comes in, less any relatable expenses that it incurred in earning that income. So this might be investment platform fees or financial advisor fees, all those kinds of things. Then you have your net income. That net income gets added to your taxable income at the end of the year. So that's the income tax side of things. The other one is the capital gains tax. Now, without going into too much detail, because it is quite complicated, but when it comes to capital gains tax, this is the tax you potentially have to pay if you sell an investment. So if you had an investment property, I always like to think about investment properties because they're the easiest one to understand. If we bought an investment property for $500,000 and we sold 5-10 years later for $1 million, we've made a $500,000 profit. Now that $500,000 profit, assuming it's an investment property, if you never lived in it, etc., there's a couple of other things to think about, but it's been an investment property for the entire 10 years that you've held it. That $500,000, subject to what's called capital gains tax discounts, that $500,000, you have to pay tax on some of it. Now, again, depending on how long you've had the property for, what your taxable income is, what stage of life you are, etc., would depend on how much tax you pay on that profit. But it's just important to know that there is income tax, which is the tax on the net income from any investments that you earn. And then there's the potential capital gains tax, which is any profits you've made after selling this investment, whether that's a share portfolio or a property. So as it can get quite confusing, so it's a really good question. But if you have a particular question or something that's slightly more complicated, I always suggest, again, do your own research or talk to your accountant or talk to your financial advisor about what are the potential tax implications of this investment, because there's going to be different investments are going to have different tax implications. So it's really important to understand what that is before you potentially get involved in any investments. But the summary of that is, if you are paying tax, it means you have been making money. So again, no one wants to pay tax, no one likes paying tax, but if you're paying extra tax, it means you're making money, which is a good thing. So thanks for the question, Lisa.